What's up, guys? So this is my first critical update episode of the channel. And the reason I'm posting this midweek is because on Friday, Jerome Powell, the chairman of the Fed, is going to give a keynote speech at the Jackson Hole Conference. Now, if you don't know what the Jackson Hole Conference is, it's basically an annual gathering of central bankers. It's kind of like the Davos of central bankers. And the reason why this year is so important is basically because the market's expectations of what he's going to say is so opposite and diametrically on the other side to what he may actually do. And whenever you have this type of an imbalance between expectations and reality, you could have a severe reaction in the market. Now let's take a quick look over here. I put this chart together to show you the last time we had such a diametric opposition between expectations and reality was in August 26, 2022. That was the last time Jerome Powell gave his keynote speech at the 2022 Davos conference. And there he came out and was very hawkish, meaning he was all about raising interest rates and tightening money supply, which was completely the opposite of what the market expected. Market tanked, right, over 3% that day. And basically after that, we did have a recovery, but it was lights out after that, heading into the fourth quarter of 2022. What also happened was leading into this in 2022 was a huge summer rally that I didn't show you, but you can just check the chart out yourself, that then was killed off by essentially the Jackson Hole speech that Powell gave. Now, here we are in 2025, 3 years later, on August 23, on Friday, he's going to give his speech. We had a huge summer rally, just like in 2022, leading into this, right? Started faltering a little bit because there were a few people who were a little bit worried about what, Jerome Powell was going to say and cashed out early, the smart people. Then there was a couple of days of rally, like basically Thursday and Wednesday leading into it, which we may have a little bit of a rally here, right, of some. And then could it be that he gives a speech that's, again, very hawkish, that then causes the market to tank overall and basically go down into Q4 of 2025? Now, as we know, Jerome Powell does not like Trump. He's not been lowering rates, even though Trump's been hammering him to do so and threatening to fire him. And if you know Jerome Powell, he's an academic, right? And he's been holding out so long, and he knows he's going to be gone early next year because he's not going to get renewed. So why would he at the end bow down? He would not do that, right? What he wants to do is preserve his legacy as a smart academic who, in the face of the data, held up to political pressure to do the right thing. His hero is Paul Volcker, who increased rates up to 20% in the 70s when they were hit with stagflation against the will of the government. Government always wants low rates, right? Because it's more funny money for them to play with. Volcker didn't do that and raised up to 20%, right? 20% interest rates. That's his hero. And that's what Powell strives to leave as his legacy as well. So there's no reason why at the very end he would just cave in and start lowering rates, right? That's a scenario from just a personal perspective that it's highly, highly unlikely, right? Given where he's at and what he's been doing all this time. Now, if we look a little bit further about what's going on with the markets yesterday, okay, the FOMC meeting minutes, basically the notes from the last Fed meeting came out. And in that meeting, they said twice. So I posted this on our Discord just to give a quick snapshot so people don't have to read the thick meeting notes. But basically there are four main points, right? And each one of these, you gotta understand, when the Fed comes out with these meeting notes, they noodle over every single word because they know the markets digest each word and factors it in. So they take great painstaking care to make sure they're very careful with every single word they put out in the meeting notes. Now, out of the 4 bullet points, 2 of them, right over here, talk about how it takes time for the tariffs to show up. That's 2 out of the 4 points, right? That means they're greatly concerned that things are still on their way, that's going to be working its way into the economy. Particularly, the impact they're looking at is inflation. Without saying the word inflation, they say it in another way over here where, interestingly, they say inflation risk is greater than employment risk at the moment, right? Okay? And then the most surprising thing that caught me off guard was now they're saying, this is a new one, right? This is a new one right here. Elevated asset valuations. So things are bubbly, right? Assets, the stock market, housing prices. Things are very expensive. These are not things that you would want to hear where you think the Fed chair is going to go dovish and talk about cutting rates, right? He's talking about bubbly stuff, very expensive asset valuations. He's talking about tariffs, inflation coming in. It's delayed, but it's coming. We still haven't seen it yet, right? And then he's talking about how inflation's more important than employment and trying to, contain it. So every single bullet point's telling you they're not geared towards a dovish and interest rate lower. And this is not just Powell, right? This is the entire Fed committee itself. The majority is what you're seeing here. So it's highly unlikely that on Friday, Powell's going to come out and be hawkish, both from a personal reason, right? Legacy perspective, and then from the overall committee based on data perspective. Meanwhile, the market has factor, and yes, we have to look at Polymarket because even the major investment banks now look at Polymarket for a real up-to-the-minute pulse of what's going on thanks to the internet. 90% chance of rate cuts this year, right? Whereas now some of the investment banks, Morgan Stanley says they won't cut rates this year. The herd, right? Woo, 90%. This is a huge discrepancy, right? If you look at the Polymarket chart, how to get up to 90%? Well, it was a CPI data. Remember that CPI data that came in, the CPI data that came in soft, which really wasn't, because as you saw in my last episode, cell imputation, it's all fudgy data. If you haven't seen that episode, you need to look at that, right? You need to know what's going on. Skyrocketed up, and we saw that dip yesterday because of the FOMC meeting notes. But basically, this is a very, very misaligned expectation with what may happen on Friday when Jerome Powell gives his keynote speech. Now, quickly, I want to talk about what's going on in the job markets, because as you know, if you've been following me, the job markets have been revised down every month of every single month of 2025 been revised down, with the last two downward revisions being huge, like 250,000 jobs just revised into oblivion. Now, this is not new, but it's telling, right? Look, this is going on underneath. You got to understand the economy and the job market is a lot more horrendous than it seems on paper, because they keep revising things downward. And last month, it got to a point where they couldn't hide it anymore, that Trump had to fire the lady at the head of the BLS, because it was just too big a gap, right? They're going to blame it on Doge cutting jobs at the BLS and whatnot. Whatever you want to call it, there's a huge gap. Reality is not what expectations is. And so that's happened, right? But what's going to come, and I don't know if much people are looking at, is in the beginning of September, what happens is the BLS will come out and give an annual reduction, right? Their annual estimate revision, right? So the last time in 2024, Goldman Sachs came out and said, hey, look, it's going to be really bad this year, right? It might be a record bad year in 2024 because they kept revising. So the all of 2024 could be up to almost 700,000 jobs that just never existed. Well, this year, and look, what happened last year was they were right. It almost was 700. This was the estimate. This was what it was, right? This year, Goldman's coming out and saying it could be up to 1 million jobs, right? Could be up to 1 million. The median is here. But it could be up to 1 million jobs, right? Which would be a record revision downwards for 2025. Never in history have we just disappeared 1 million jobs throughout the course of a year. And that data is coming out on September 6th, I believe. Right? Trust me, if that comes out anywhere near 1 million jobs just vanishing that they said they created, but it was never created, right? I mean, this is cooking the books to the maximum. That's going to take a huge toll on the market. And people are going to say you're going to have to now lower interest rates at that point in the future after Powell gives his speech, because the job market's tanking, which is a sign of a recession. Now, here's the thing, and I'll leave you with this, right? If you have high inflation and a tanking economy or a recession, You call that stagflation. It's the worst of both worlds, right? You're getting poorer because of inflation, and at the same time, there's no jobs and people losing jobs because of a recession. The last time that happened was in the 70s. It was a very painful setup back then. We also had the OPEC oil crisis, right? Which in today's world is like another flare-up between Israel and Iran. The point here is that in the 70s, you had a guy who was chairman of the Fed named Paul Volcker. And he did the tough thing of saying no to the government and raising interest rates to protect the dollar and lower inflation at the expense of the economy suffering. And they had bad recession back then. He raised rates all the way up to 20%. 20%. Dude, we're at like 4%, right? He raised it to 20%. Imagine mortgage rates at 20+%, right? He had to do that to protect the currency from complete debasement, right? And it was a very, very tough thing to do. And that's why he's lauded as one of the greatest Fed chairmen of all time. Because of what he did back then, we're here today, and everything's still hunky-dory. Powell views Paul Volcker as one of his heroes, right? And so that's why Powell's not going to crater here and lower interest rates. Not given the data like the producer price index data, which came in 100 basis points higher than expectations last week. Remember, I talked about that in the last episode. No way, with tariff impacts still coming in. But what happens after Powell leaves? Well, guaranteed, whoever the Trump administration puts in is going to be somebody who's a dove and wants to cut rates just like Trump wants them to and Bessent wants them to, right? So they can play their strategy, right? Which I'll talk about in some future episode of how they plan to get the U.S. out of debt. However, if that Fed chair, whoever gets put in the face of stagflation, does the opposite of what Paul Volcker did, right? Which is the easy thing to do, which is to just cut, and go on the drugs of cheap money, right? We may be looking at inflation that gets out of control. Will it become hyperinflation like that? I don't know. But it will be high, right? And that's going to cause all kinds of problems. Which is why in the long term, you want things such as gold, perhaps BTC, and other assets that hold value in times of inflation because of the political situation, who's going to be installed as a Fed chairman, right, once Powell leaves. So having said that, I hope you enjoyed this short episode. Be careful of what happens on Friday when Jerome Powell makes his speech. Let's see if we have a repeat of 2022, just like I showed you at the beginning of this episode. See you in the next one. Peace out.